Hello guys, and welcome to another week ahead video. Now we have a couple of very interesting economic data points that will be released this week. Amongst that we have the ECB's monetary policy decision as well as the Bank of Canada's. We have some CPI for Canada as well as the flash PMI numbers coming out for Europe. We also have a very important jobs report coming out for Australia. But the currency that we'll be focusing on today is again the pound. We think we have some interesting economic data events coming up next week, like the jobs report as well as PMI numbers for the pound, that has potential to really move the pound. Reason for that is we have seen a very sudden dovish tilt from the BOE recently. Going 2 weeks back, we were sitting at a 0% probability of a rate cut by the BOE in 2020. And now currently the market is sitting at a 70% probability for a rate cut by the BOE as soon as the January meeting at the end of this month. So we are definitely focused on the pound this week. Jump with me into the video to see how we can prepare for this week's events and hopefully possibly trade them as well.
Okay, then looking at the baseline for the pound. Now currently we do maintain a bearish bias for the pound, both fundamentally as well as sentiment wise, and the past week's data that we got and events gave us plenty of reasons to keep that bearish bias intact. Firstly, we had the economic data. A majority of the week's important data points came out with negative surprises to the downside. The GDP numbers for December contracted. The month-over-month number contracted by negative 0.3% versus expectations of a 0.0 and a minimum expectation of negative 0.1%. We also had the industrial and manufacturing output measures monthly coming in below the market's minimum expectations. Now, one of the more important data points that we had was CPI, which also came in well below consensus, as well as also coming in below the market's minimum expectations and hit more than a 3-year low. Now, the drop in headline numbers also saw the more important core measures being dragged down lower as well. And then also on Friday, the final data point of the week was retail sales for December. Usually the seasonality of December with Christmas supports higher consumer spending. However, the December retail sales data showed that consumers cut back on spending and cut back quite considerably if we look at the drop that we saw in the year-over-year number. Now, we had the contraction in both the monthly headline as well as the core measures, which basically meant that dragged down the year-over-year numbers, which printed below the headline year-over-year number as well as the core year-over-year number, both of them printing below the market's minimum expectations for December. Now, what's more important though is that according to the ONS, the Black Friday sales were also pushed over into December, which means that the sluggish consumer spending really doesn't bode well for GDP, especially considering that the contraction in the monthly retail sales metric showed that sales volumes in monthly terms hasn't risen since July, which is the longest run going back to 1996. So at this stage, growth really under pressure. The ONS also added that food sales, which is usually expected to pick up over the festive period, fell by the most in over 3 years. Now, apart from the economic data, we also had BOE's Michael Saunders on the wires this week. Now, his comments were important because you guys will remember that he was one of the dissenters that voted for a rate cut in the 2 final meetings of 2019 for the BOE. And his comments this week, even though expected to be dovish, did come across the wires more negative than expected by saying that if the BOE is going to act, the current economic climate in the UK means that rates need to be cut right away and they shouldn't tarry on any monetary policy decisions. Now, the reasons given by Saunders for his views on the economy included concerns about the labour market as well as the sluggish economy, which basically just echoed the same rhetoric that we heard from both Carney, Tenrero, as well as Vliga last week. Now, the disappointing data as well as the dovish comments and rhetoric from BOE policymakers saw that the market, according to CME, is now pricing in a 72% chance of a 25 basis point rate cut at the January meeting, which is basically at the end of this month. Now, apart from all of this, the market also started to price in the possibility of a messy Brexit right after the general election, with the hardline stance taken by the UK government regarding the December 2020 transition deadline. Thus, at this stage, it does seem like all the roads are pointing to a more bearish bias on the pound at present. Now, looking at the risk events for this week there are 2 important data points to watch for the pound. First on the calendar is the November jobs report, which is scheduled for Tuesday. Now, both BOE Saunders as well as Tenrero mentioned recently the concerns that they have about the labour market, which means that there should be a lot of added focus on this event. Now, we already had a miss in GDP as well as CPI, which means that a miss in the jobs report will basically give us a hat trick of negative surprises on the three most important economic measures. Now, markets are currently expecting headline employment to have risen by 104,000 from a prior of 24,000, with the unemployment rate expected unchanged at 3.8%. Now, another important metric to keep in mind is the earnings, which are expected to ease back from their prior numbers as well. Of all the economic metrics, the labor market has arguably been one of the more positive measures. However, if we take a look at the employment on a year-over-year basis, we can see why some of the BOE members would be concerned that the job market boom might currently be slowing, as we are currently below that 6 as well as that 12-month average, and we have been trending lower, to be fair, from 2013 as well. Now, the other important data for the week is the PMI numbers due on Friday. Now, the most recent PMIs has been all but inspiring, with the services just barely reclaiming that very important 50 level. Now, all three metrics are expected to beat prior numbers this week, but the forecasted distribution for both the manufacturing as well as the services is a mixed bag at this stage, which shows that there is plenty of risk for surprises in these numbers on Friday. Now, looking at the possible sentiment shifts and starting with the possible dovish sentiment shifts, for this week, we'll be looking at the possible dovish sentiment shift to occur from any surprise negative deviations in the pound data, like the jobs report or those PMI numbers. A further deterioration in the jobs report will be the last confirmation that the market needs to fully price in a rate cut by the BOE at their January meeting, and could create some short-term selling opportunities. Following this, the PMI numbers will also be important. Given the current negative sentiment that we have on the pound, the biggest conviction trade from the PMI numbers would be a miss across the board, as that'll feed into that current negative bias. Also, watch out for the speech that we have by BOE's Haskell. If we see a fifth BOE member making an overly dovish comment, it could just provide further downside pressure on the pound. Just keep in mind that Haskell is considered a dove, also one of the descendants with Saunders. So his comments would need to be overly dovish to garner any real bearish sentiment from his words. It'll also be important to see how these events change the current rate cut expectations. We know that currently the market is sitting at 72% probability. So we need to evaluate that in order to see the significance and sustainability of any moves resulting from either the jobs report as well as the PMI numbers. Also, keep an eye open for any major negative developments between the UK and EU in terms of the trade deal negotiations, as that'll just add fuel to the fire of that current negativity. The other interesting thing just to keep in mind in terms of the COT data shows that the pound longs has significantly increased on both a 1 year and 6 month basis in terms of their Z scores. Now, the large rally seen from the start of October 2019 could explain a lot of that positioning, but it is noteworthy that we haven't really seen any sizable reduction in long positions given the recent more negative developments. Now, it's also important to note that the COT data is only updated until Tuesday the 14th of Jan, so it is possible that some of the long positioning has already been trimmed following the CPI and retail sales numbers, which basically occurred after the latest COT data. Now, on balance though, the data does show that the long positioning might be somewhat stretched at this stage, which means it'll take far less for us to see more downside compared to further upside in the pound. Now, for the highest conviction trade in the pound to the downside, we would want to see a miss on all the key data points, that is the jobs report as well as the PMI numbers for this week, accompanied by possible negative trade developments between the UK and the EU. In terms of hawkish sentiment shifts, given the dovish comments made by BOE members this week and last week, it will take a lot more from the data to see any meaningful upside in the pound, even if we do see surprise deviations. However, seeing that the jobs market has been mentioned by two of the MPC members, that is Tenrero as well as Saunders, we might see a reduction in rate cut expectations if we see any surprise deviations to the upside in these important data points. So do make sure to watch out for that jobs report. Also, the dovish data this week pointed to further deterioration in growth, thus a drastic turnaround in the PMI numbers could put a question mark on the prospects for future growth and might also see a reduction in their rate cut expectations. So do keep track of those ones. For the biggest conviction trade in the pound to the upside, we would want to see a big beat on all the key data points for this week, accompanied by possible positive trade deal announcements between the UK and the EU. Now, how you can look to trade the pound in the case of a dovish sentiment shift on the pound, we could look to pair the pound against something like the Canadian dollar, which has been supported in the past 2 months by a more upbeat tone from the BOC, as well as the jump that we saw in oil prices in December. One thing to keep in mind, though, is if you are going to look to pair the pound with the CAD, just make sure that you're trading in line with the current risk tone at that time, as a positive or negative risk tone will affect the CAD. Also, make sure to keep a track of oil prices, as it's another idiosyncratic factor for the CAD. Also, make sure to watch out for CPI coming out for the CAD, as well as the BOC rate decision also due this week. Now, in the case of a hawkish sentiment shift on the pound, we could also pair the pound against something like the US dollar, which has been trending lower from October 2019 due to a string of negative data points, as well as market expectations for further easing by the FOMC in 2020. We did see some upside for the dollar, however, in this past week. So just make sure to keep track of that short-term moves and volatility that we can expect from the dollar if we do see that type of move continue in the week ahead. Remember, guys, that these recommendations for which pairs to trade or which currencies to pair against the pound are based on the current fundamentals and the longer term fundamental biases for these currencies, and that is at the time of writing. Now, that can obviously change throughout the week in terms of the short term sentiment, so make sure to reevaluate whether the short term sentiment is still valid for these currencies before you take any trades. Now, these type of sentiment shifts that we've discussed are valid for trading phase 1 trades. Now, if you want to learn how phase 1 trades work, you can check out our news trading strategy playlist on our YouTube channel, where we post weekly examples on how these type of events play out. Now, after a phase 1 move, we can also look for potential phase 2 pullbacks of that initial move, and we post updates on these moves inside our tradable sentiment shifts report inside the Forex Source terminal under the Market Insights tab. And you can also see each day which sentiment shifts are still in play and which ones are still valid for trading the phase 2 pullbacks. And you can also learn about how these setups work during our live analysis webinars each day inside the Forex Source terminal.